The views and opinions expressed herein are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Private Asset Management or its affiliates and are subject to change without notice. Private Asset Management has no obligation to provide updates or changes.
Hello, and welcome to the 2017 second quarter economic review. I'm Jeff Witt, Chief Investment Officer of Private Asset Management. To begin with, we're going to go briefly over the different asset class returns that we saw both in the second quarter and year to date. Looking broadly at various asset classes, you can see the S&P 500 has done fairly well on a year-to-date basis, up roughly 11%. The Russell 2000 index is up only 6%. However, if you looked over the last 12 months, the small cap index has actually outperformed. International markets, as reflected by both developed and emerging markets, continue to post pretty phenomenal returns, with developed markets up over 16% and emerging markets up over 23% year to date. Moving to the Barclays Aggregate, which is a fixed income index, that is up about 2%. This is something that we anticipate will see muted returns here going forward as the Federal Reserve continues to increase interest rates. And then finally, the Bloomberg Commodity Index was actually down over 5% for the year. This is largely the result of lower energy prices. In the second quarter, we actually saw the S&P up about 3%, but there's a pretty wide divergence among the different sectors, with the best performing sector being the healthcare sector, posting returns in excess of 7%. On the other side of the spectrum, both energy and telecommunication posted pretty sizable negative returns. Telecommunication is experiencing this because of the pricing war that's currently going on among the major carriers in the U.S., and that's leading to concerns regarding profitability among these firms. Switching to the fixed income indexes, these, by the way, are total returns for 2017. As we noted, the U.S. aggregate, the Barclays aggregate, was up a little bit over 2% year to date. Most of these returns are pretty much comparable to what their current yields are, which is something that we anticipate going forward. The one noteworthy exception was the TIPS market. Those are the inflation-protected securities. We actually saw those decline and post losses in the quarter, though they are up 1% for the year. Lower inflation is leading to some concerns regarding these types of securities. Moving on to the economic backdrop, here's our outlook for the year. We're forecasting GDP growth in the U.S. to be between 2 and 2.5%, unemployment between 4.5% and 4.7%. Inflation, we've actually ratcheted down a little bit, between 1.5% and 2%, with global economic growth holding steady with a forecast of 3%. In the first quarter, we actually saw U.S. GDP decline, falling to 1.4%. That's the circle represented in these charts. The bar charts represent the various subcategories of GDP. A couple noteworthy things is we saw the maroon bar, which is personal consumption, decline fairly dramatically. Fortunately, fixed investment, which has been kind of one of these hallmarks of low fixed investment throughout this recovery, really came roaring back, and you can see that by the more brownish gray bar here in this chart. We believe the issues with regard to personal consumption are somewhat transitory in the fact that this was several one-time factors impacted these results. Most noteworthy is the delay in income tax refunds. You can see this blue line here on the left side was significantly below what we'd seen in the past years, but that has since rebounded. And when you go to the right, you can see we're now trending above what historically we see with respect to income tax returns. Now, these returns normally go to individuals that spend them rather quickly, so we would imagine these results will show up in the second quarter. Another thing that keeps us somewhat confident we'll see increased personal consumption is the consumer confidence. That is represented by the white line in this graph. You can see there's fairly good correlation between that and personal consumption, and both seem to be at relatively elevated levels. Moving to fixed income investment, that still looks pretty positive. The orange line here is a CEO confidence metric, and you can see there is a correlation between that and fixed income or fixed investment spending. Here again, it looks like the CEO confidence is fairly elevated to where spending is, so we would imagine we'll continue to see companies investing toward the future. Unemployment has really pulled back. The unemployment rate is at 4.5%, which is kind of the lower range of where we think it will be for the year. The underemployment rate, which you sometimes hear, that adds in a few other types of individuals, such as those working part-time for economic reasons, has declined too. And that rate is about 8.9%. Both of those are really close to what their long-term averages are and indicative of a economy close to full employment. However, we haven't seen a significant increase in wages. They have been trending up lately, but they're still below what we saw pre the Great Recession here. So this is one thing that we're going to continue to monitor, and would be really a welcome development to see wage growth accelerate. As I noted earlier, we saw inflation really slow in the quarter. It had been running at close to the Fed's 2% target. However, most recently, the core rate had fallen to about 1.7%. However, we note that a large part of that decline was a reduction in bills for telecommunication services. As we noted, the price wars among the major carriers is really driving down bills. So if you X that out, we still remain close to the 2% target for the Fed. Speaking of the Fed and moving to monetary policy, the Federal Reserve did increase rates by a quarter of a basis point, or a quarter of a percent, 25 basis points in the quarter. And they have indicated they're on track to increase rates at least one more time. Now, this is a chart. It's called the dot plot of the Fed's estimates. The green line on this is the median estimate. So you can see one more rate increase this year, with several more yet next year, moving to a long-term target of roughly 3% for short-term rates. However, we note the other lines on these are more market-based indicators, and those seem to be somewhat skeptical the Fed will be able to achieve this rate hike. The other thing that came out in the quarter is the Fed will start rolling off some of its securities that it holds on its balance sheet. Up to this point, it has been reinvesting these securities. But we have learned that they're going to start off by allowing $6 billion in treasuries and $4 billion in agencies and mortgage-backed securities start rolling off. We anticipate that'll start to occur sometime this year. The one troubling spot in the market is valuations. You can see the S&P, represented by the white line here, has done phenomenally well over the last few years, up roughly 300% since the end of the recession. Emerging markets and developed markets, the other two lines, haven't posted as similar returns. We think there's some opportunities in these areas. That's also represented in the valuations. This graph here, you can see the dots, the current valuations represented as their 10-year averages, with the S&P close to a 10-year high. The Russell 2000 is right around its 75% mark. And the MXCI developed market and the emerging markets are both closer to their median averages. So we do think there's a little more opportunity international. Even with valuations being somewhat stretched, this is a chart that represents equity valuations relative to bond valuations. And it seems to indicate that S&P, the equity indexes, are actually cheaper than bonds. So even with valuations being somewhat stretched, we don't think that they are relative to fixed income investments. And therefore, we're still very comfortable with maintaining our equity allocation relative to fixed. That's about all I have for the second quarter review here. As always, we continue to monitor all these economic events on a daily basis here. And should you have any questions regarding any of the material here or any concerns regarding your accounts at Private Asset Management, we encourage you to contact us. And thank you for your attendance.